All right, let's get started, everybody. Hi, everyone. Welcome to today's webinar. It's called the No Sale Life Insurance Sale Using Policy Reviews. I'm Lloyd Silver from Gateway. Will be your host today. I'm going to be muting everybody, so if you have any questions, please type them in the chat box and I'll answer them as we go. Or if we run out of time, I'll make sure I get back to you right afterwards. This is actually the most highly attended webinar we've ever done, and I actually find that very interesting. We've had webinars on estate planning, business planning, premium financing, interesting strategies using annuities, and our most successful webinar to date is on policy reviews. I find that very encouraging. As financial professionals, we recognize that in the midst of everything we do, getting back to basics is still vital to our success. Now, if I went out and asked 100 life insurance agents if they thought doing policy reviews was important, my guess is that I get about 100 who would say yes. And if I asked them if they thought doing policy reviews would be profitable for them, maybe about 95 would say it's true. But if I asked them if they themselves actively conducted policy reviews, I bet we wouldn't get more than about 10 who said they did. And why is that? Why is it that agents acknowledge the importance of policy reviews, that policy reviews would actually make them more money, yet very few engage in the practice on a regular basis? Now, there are likely quite a few reasons why this is the case, but one I think that's both relevant and very easy for us to address is that most financial professionals, despite being great advisors and great salespeople, have a hard time implementing new ideas, even the most basic ones, into their practice. What they need is a system, something that they can easily implement. And this isn't a knock on agents. It's simply that implementing new ideas into an otherwise busy practice, that's a different skill set than that's required to be a highly successful advisor. And that's what I hope to tackle today. So if you're already using policy reviews, fantastic. If you're not, I'll lay out a step-by-step system that you can use and start doing them right away. Let's start getting into details here. First, let's start off with a high-level approach. So what are we actually talking about? And I want to make sure everybody is on the same page here. What exactly is a policy review? Here's my definition. A policy review is an unbiased analysis of an existing life insurance policy to determine if the policy is performing as originally expected, to determine if the policy will fail before the client fails, to look at the beneficiary designation and the current ownership to make sure that they're correct, and to find out if there are better alternatives available in the marketplace. Now, based upon our experience, what we found is that over 60% of the reviews that take place actually improve the client's situation. And by that, I mean we can either lower their premium, provide more death benefit, allow the life insurance to remain in force for a longer period, improve the guarantees, and or solve major issues involving their beneficiary or ownership. Now, the title of today's webinar is the No Sale Life Insurance Sale. And what I mean by that is quite simple. During a policy review, there's no new sale being made. The end result might be that you replace their policy with something better, but the actual sale was made at the time of the original policy, either by you or the agent that wrote the policy if it wasn't you. What you're doing is simply providing them a service, an unbiased analysis of their life insurance policy. And by providing this service, you're either going to improve their current situation or you'll give them peace of mind that everything is okay with their policy. And either way, you come out very favorably. Either you're a hero when you make things better for them, or you're a true financial professional when you confirm that things are just fine the way that they are. Now, I think this is incredibly important for every agent, but it's even more important for agents whose main focus is not necessarily life insurance. Professionals like property and casualty agents, investment advisors, financial planners, accountants. While these professionals might be the absolute best at what they do, they might not have the credibility necessary to simply go into a client or prospect and talk about life insurance if they've never had a conversation about life insurance with them before. But by doing a policy review, it's a very low-risk, non-threatening way for you to engage a client or prospect in the conversation regarding life insurance and regarding their policies. So let's get into the details now and explore why we do policy reviews, with whom we should do them, and how they're actually done. So let's take a quick look at some things that have been happening in the industry. Just a few things that I think are really important. First of all, we all have experienced the economic downturn, and unfortunately, Some of those effects are still lingering. They've had impacts on carriers. The financial strength and ratings of carriers today are not quite what they were 5, 10, 15 years ago. And that's certainly important for your clients to understand that the carriers that they bought their policy from originally might not be as strong today as they were when they bought the policy way back when. Of course, another big issue is that the industry is adapting to a lot of medical advances. People are simply living longer. And this, of course, affects the pricing of life insurance. If people live longer, they pay premiums for a longer time period. The death benefit isn't paid out to a date further in the future. Things are much less expensive to buy insurance today than they were years ago simply because of those medical advances. Another big issue we can just talk about generally speaking is that life insurance today is designed, priced, and underwritten differently. We have new products, whether it's an index product or a guaranteed product. And in fact, with guaranteed products, when they came out first about 10 years ago, they became very common. The pricing of those policies was very, very different than the pricing of a guaranteed policy today. And in fact, we've seen a lot of carriers pull out of that guarantee market altogether because they just don't feel like they can put out a product that is competitively priced, yet profitable for them to actually sell. So the products that we're dealing with are different. Underwriting has taken a very different approach. We have simplified underwriting in some situations. Your pharmaceutical records become more important. Some illnesses or ailments that people have might not be as critical today because we have a better understanding of what they are and how they can be treated. So all that taken into consideration, life insurance today is a very different animal than even 10, 15 years ago. And certainly if you've got policies that are that old or even longer, things have changed quite a bit. And so it really is important for us to take a look at those policies to make sure the clients understand how things have changed and how those changes impact them. Now, all of this, of course, is simply an opportunity for us as agents to get in and have these types of conversations. And so I look at this all as incredibly positive. So let's take a look at what policies need a review. And we get policies in our office to review quite frequently. And, they're 2 years old, on a 30-year-old. These are not the policies that absolutely are critical to review. Now, I could give you a short answer to say that all policies need a review, and that's probably true, at least periodically. But let's take a look at the ones that absolutely need a review right now if you have clients or prospects that have these types of policies. First of all, if you have any that have experienced any major life changes, any major life change, new job, new business, new spouse, new kids. Of course, these are all reasons why they may want to take a look at the life insurance coverage they have to make sure it's still appropriate for them and whether any changes need to take place. So that's very much a no-brainer. Clients over the age of 50 with policies over 5 years old. I think if you want to try to do a bundle of clients to do policy reviews with right away, this is the group that you want to look at. They're older, health issues may change, the policies are at least a couple of years old. Surrender charges might not be as significant today as they were, 2-3 years ago. They've at least had a couple of years to take off some of those surrender charges, which is obviously important when we look at replacements. But I think when we look at policies that are at least 5 years old, we have enough changes going on in terms of the industry changes and the way policies are being issued that the conversation becomes a little bit more relevant. If you sold a policy a year or two ago, chances are there's really not much that you can do. Those policies, unless it was written by someone else and they made a critical mistake, but if you wrote that policy and you did a right job at that time, a 1 or 2 year old policy is just not worth it. But when we get into these older ages and policies at least 5, if not 10 years old, now we're talking policies that we can actually really do something with, and we can certainly at least improve their situation or confirm that everything is okay. Clients that have had a significant improvement in health. This is absolutely a key. I'm sure that you've got clients out there that bought a policy and they got a standard rating or even just a regular preferred versus preferred best. And have they had any improvements in health? If they had, we might be able to look at getting a new policy with a better rating and get them a new coverage that improves their financial situation. And then take a look at term policies, particularly those that are at the end of that flat term period. So if you bought a 10-year term policy in year 8 or 9, a 20-year policy in years 15, 16, 17, they've got to start thinking about what they're going to do with that term insurance. And so at the end of that time period, when just a couple of years from now or even sooner, they may be facing a huge increase if they can even keep the policy, that's obviously a perfect time to engage with another conversation. But also don't forget conversion periods, particularly if they've had any negative health issues. So most term policies are convertible. Some are convertible for longer periods than others. So it's really important when you sell a term policy, you understand the conversion privileges. How long can you convert and what policies can you convert into? There's certainly policies out there that when they were sold, term policies, they could convert into a pretty good permanent policy with that carrier. But is that carrier still financially strong? Does that carrier still even offer competitively priced permanent policies? And those are things that you can take a look at when you're reviewing term policies. And lastly, policies that are owned by a trust. This is very, very important. If it's owned by a trust, there is a trustee. If you're a trustee, you have a fiduciary responsibility to the beneficiaries of that trust. If you're not reviewing those policies on a regular basis, you might be violating that fiduciary responsibility. So go to folks that serve as trustees. They could be attorneys, they could be accountants, they could be professional trust officers, and ask them if they're conducting policy reviews on the policies that they serve as trustee on. If not, are they aware of the liability that they may be creating for themselves by not fulfilling their fiduciary responsibility? And that's a service that you can provide to them, and certainly have some great networking and develop great relationships with other professionals. So take a look at those policies, see if they're owned by a trust. Even if it's not a professional trustee, if it's simply an individual serving as a trustee, they still have that responsibility. And so those are fantastic folks to go to, because legally, if they're not conducting reviews on a regular basis, they could be creating some serious problems for themselves. So those are some folks that we could take a look at in terms of good candidates for a policy review. Now, this probably goes without saying, but we all run businesses here. So, it's not to say that people with small policies don't deserve to have reviews. Certainly, if you sold that policy yourself, you have a professional responsibility to conduct them. But we want to make sure that our time is valuable, and that we spend it on the right clients and the right policies. So, if you have small term policies on the books, if you've got the time, fantastic. But, we always need to be considerate of how we spend our time and make sure that we're spending it in the right place. So again, I'm not saying that smaller policies don't deserve a review, and that you're not obligated to perform a review if you sold those policies. I think that you are. But given choices, we need to be smart in how we spend our time. Let's take a look at what we need to gather in order to do a thorough review. This is all the information that we need to obtain in order to do a proper review. Now, it's very simple for us to get an in-force illustration, and just that alone, we could do a very informal analysis and give an opinion as to whether or not things can be improved, or if the policy is performing in a okay fashion. But if we want to do a real review, this is what we need to take a look at. The first thing we need to get is an in-force ledger. So that's going to be from the insurance carrier, basically a projection of how things are going to be looking in the future based upon what's happened to date and what's expected to happen going forward. So that is the absolute minimum that we need in order to do any type of review. We need to see what's happening right now, and if things continue to happen the way that they are, what is the policy going to look like going forward? Another important, and to get that, we do need to get an authorization if you're not the writing agent. If you're the writing agent, you can contact the insurance company and get it. If somebody else wrote that policy, you'll need to have the client sign an authorization. Sometimes the insurance carrier will still not send it directly to you. They'll send it directly to the client. So just make sure that they're aware if they get that copy in the mail to send it to you afterwards. So the second thing is to get a policy statement. This could be an annual statement or a quarterly statement. It's going to give you all the updated values. Are there any loans? What are the surrender charges? How much cash value? Those are all very important bits of information to have as we're comparing those old policies to what's currently available. Now, the third thing might be tough to get, especially if you're not the writing agent, but that's a copy of the original illustration. If we get that, then we can actually do a comparison and show, here's what you thought you were getting and here's what you actually got, and see if we can uncover, some problems or some differences between the original illustration and the current one. And we all know that, especially with declining interest rates, there's a pretty good chance that what clients thought they were purchasing actually turned out to be something a little bit different when we actually look at the current values versus those original ones. So that could be great if you can get a hold of the copy of the policy. Now, most clients may not even keep a copy of that policy, or they stick it somewhere and they forget where it is. If you can get it, there's good information in there. The application that is part of that policy has vital information. It has health information, has information as to why they bought the policy, some financial information. So that's always good to have, as well as beneficiary information and ownership information. Updated medical information, especially if we're looking at current alternatives, we need to have an understanding if they could still get the rating that they originally received, or have things changed? Have they improved or have they declined? Even if their medical condition has changed negatively, maybe marginally, we might be able to still improve their situation. We still want to do a review because, again, we're providing this unbiased analysis, right? Just because we might not be able to sell them a new policy doesn't mean that we don't perform the review. The outcome just might not be a new sale, but we still provide that review and still a great service. But having that updated medical information, you don't have to have lots of copies of physician statements and those types of records. We have a one-page form. What prescriptions you're taking, are you smoking, or tobacco history, a little bit of family history. Very simple, takes them a couple minutes. You've got all the information that you need. Next is confirmation of who the owner is and who the beneficiary is. Do not ask the client who the owner is and who the beneficiary is. You need to get that from the carrier. It is very common that who the client thinks owns the policy or is the beneficiary of the policy is actually not who in fact is the owner or the beneficiary. Things change. Maybe a beneficiary form is completed but never sent into the carrier or never processed by the carrier. This happens more often than you can imagine. When we take a look at those current policies and get the current statements and we see the owner or the beneficiary, maybe it's an ex-spouse. Maybe the beneficiary is a child, but they've had another child since then. Maybe they thought they were putting into the trust, but it's not into the trust. Now, these are potentially major issues, major financial issues and tax issues, but major family issues that can be avoided by making sure that we know exactly who that owner is and who the beneficiary is and review that information with the client. Take a look at that carrier financial information. And like I said up front, things have changed. There are carriers today that just weren't as strong as carriers 5 and 10 years ago. Things have changed. Those carriers may not be the same, A-rated carrier today that they were, 5 or 10 years ago. So let's take a look at that. And then, of course, most importantly, why do they buy the policy to begin with? What was their objective? What was their goal? That's important to make sure that if we do look at alternatives, we're meeting those same goals, but also to reevaluate and make sure that those objectives and goals are still relevant today. So having an understanding of why they got the policy is certainly critical to all of this. Here are all the questions that I think need to be answered when we do a policy review. I think this really covers the gamut. If you can answer these questions, you've done a very thorough policy review. First of all, what will happen to the policy if current premiums continue to be paid? Right? So this is that in-force ledger. So we order that in-force ledger and we ask the insurance carrier to continue showing us the premiums that the client has been paying in the past. And then what's the policy going to look like if things continue at both the current rates, so the current interest rate, the current mortality rates, and also at the guaranteed rates. And those are things that we want to provide to clients, both of those, current rates as well as guaranteed rates. So that's the first thing we want to take a look at. If the client keeps paying the premiums today as they have in the past, what's going to happen to the policy? Is it going to run out of cash? Is it going to lapse? How long is the guarantee for? Now, if the policy is going to lapse based upon current premiums, what premium is actually required to make sure that there's death benefit to age 100 or to age 120 whatever you'd like. People are living longer. You may want to just show to age 100. Maybe you want to show to age 120. That's going to be up to you. But if the policy is going to lapse based upon the current assumptions, so their current premiums, how much would they actually have to put in to make that policy work? There's no sense talking about policies that are going to fail. That's why we're doing this. We want to take those policies that may fail, review them, provide alternatives. One of those alternatives is simply keeping their current policy, but increasing the premium to make sure they don't fail. Another question, which I alluded to before, is how is the policy performed compared to the original proposal? And this can be very unsettling for clients. When they look at that original illustration side by side to what has currently happened, hopefully, if you sold the policy, you did a good job preparing your client for what would happen in the event of a downturn. If not, then at the very least, you're identifying the problem now before it becomes something that is even more significant and perhaps not recoverable from down the road. And if it's another agent, then it's a great opportunity for you to show them, why isn't that agent talking to you about the problems that are happening in this policy? Why is it that I'm doing that now? I'm identifying those problems. I should be your financial professional and your life insurance agent going forward. Another question, again, is how financially strong is the carrier? They thought they were buying from an A-plus carrier. That's now an A-minus carrier. Are they comfortable with that? Are they okay with having a policy issued by a carrier that might not be top tier? There are a lot of very strong A-rated and A-minus rated carriers. There are also carriers that used to be A-rated that are now in the Bs. And I'd be a little bit concerned if I was a client that owned a policy issued by one of those carriers. That alone might be a reason for them to make some changes. Even if the policy is performing okay, it might be performing okay because the insurance company is making some very questionable investments and has actually put itself in peril. So that's a very important question to look at. Now we start getting into to looking at some alternatives. So one question to ask is, assuming that they pay the current premium, so what they've been paying the last couple of years, 5 years, 10 years, or whatever, what death benefit could they obtain if they go out and buy a new policy? And how would those guarantees compare? So could they actually go out paying the same premium today and get a policy that has a higher death benefit? Or if not a higher death benefit, could they actually get a policy with longer guarantees? And maybe that is important to them. They can pay the same premium, get the same death benefit, but have that death benefit guaranteed for a longer time period. Or they could maybe go out and get, for the same premium, a policy that provides even more death benefit. And that happens very frequently because of the changes that we talked about initially. Another thing we look at is, let's assume that we keep the death benefit the same. So if they own a $500,000 policy, let's go out and look at $500,000 policies today. And can we actually lower their premium by getting a new policy? And that's an alternative that might be very, very favorable to them. They have enough insurance. They don't necessarily need more, but maybe you can save them a few dollars by going out and getting a new policy. And of course, if you're, for instance, an investment professional, can we now take the money that we saved them on their life insurance and perhaps put it into a mutual fund, an annuity, or some other type of vehicle? So maybe we can save them some money on the one end and use those savings to actually help them with retirement or some other need. Who is the current owner? Does it still make sense? Again, incredibly important. This happens all the time, that the current owner is not actually who they think it is, or perhaps it is who they think it is, but it's a poor ownership decision. We could make some very bad mistakes by having bad ownership designations. So if it's owned by a third party, we have different beneficiaries, different owners, different insureds, huge tax consequences. That happens. Let's take a look and make sure that owner is still a good decision. And as I said before, who's the current beneficiary, and does that still make sense? So this may open the door for you to do a little bit of estate planning. And we talk about estate planning. It's not necessarily only to minimize estate taxes, which most folks aren't going to have today with the estate tax situation the way it is. But estate planning also includes, the proper transition of wealth from one generation to the next. And having a beneficiary designation that's not correct may impact that estate planning. They may want to put it in trust. If they don't have a trust, it opens the door to a conversation. Why don't they have at least a living trust that this life insurance is owned by? So just by looking at this life insurance, it may open the door. Even if you don't make a new sale with life insurance, it might open the door for other opportunities like estate planning, or, as I just said, saving a little bit of money on one end and maybe doing some retirement planning on another end. And most importantly, does the policy still address the client's goals and objectives? So I could include this as the very first question because it's probably the most important, but I'll save it to the end as the final reminder here that ultimately this is absolutely what our goal is in the policy review. Does it still make sense for the client? Now, it could be that they still need the life insurance, yet the reasons why they need the life insurance might be different than when they originally purchased the policy. And that could lead to a change in the owner and beneficiary. Or maybe we use that policy as a retirement vehicle down the road. So, addressing why they bought that policy, do those needs still exist? And if not, can we perhaps repurpose that policy as a very good use of our time in this situation? Let's get in, and we're probably closing into the last few minutes here. But I've talked about why we should be doing reviews, the best policies to take a look at, some of the questions that we need to answer, and the information we need to obtain to do a review. Let's get into detail and actually look at how we do reviews. And this is just our method. Certainly, do whatever's comfortable for you. Here are the 4 possible outcomes. So just remember this going in. There are 4 outcomes, and this is where it gets back to that unbiased service. We know at the end of the day that the outcome of doing a review is going to be one of these 4 things. The first is that we actually lower their premium. So in this example, again, I'm just showing what I'm talking about. They have a $1 million death benefit. They're paying $8,500 a year. They've got a 5-year guarantee on that death benefit, and it fails at age 83 based upon current assumptions. So a lower premium might be that we can maintain that $1 million death benefit, but maybe we reduce the premium down to $7,500, and perhaps we can extend those guarantees. So lower premium, number 1. Increased death benefit would be that second option. So they have a $1 million death benefit today that they pay $8,500 for. What could we get for them if we look at a new policy? In this example, I am showing $1.4 million. Just an example again. I'm not saying, I don't have any ages here, but I'm just trying to describe what I'm talking about. This is a very common situation that we can take their existing policy, their existing premium, and actually get them more death benefit by having a newer policy, a better policy, perhaps a more efficient policy than what they originally purchased. The third alternative is that everything is fantastic. They've got a great policy issued by a great carrier. There's no alternative better in the marketplace. Now, you may not be solving some major problem here, but you're doing a great service. And that, at the end of the day, is why we do policy reviews. So at the very least, you have assured them that their policy is working just fine. If you sold that policy, you're reconfirming that you're a true professional, that what you sold is still fantastic for them. If someone else sold that policy, you're just giving a great second opinion. But now you're engaging with them in a life insurance conversation that maybe you didn't have before. And that's, one of the purposes of doing reviews is that it helps us engage in conversation, particularly for those folks that are not life insurance focused day in and day out, but they have a great business. They've got great clients that certainly own life insurance, but maybe they're not comfortable having that detailed conversation about life insurance yet. So we do it through a policy review. And worst case scenario is that we walk away telling them that everything is fantastic, but we've been able to show them that we are a professional, that we do understand life insurance, and we do have them and their family in our best interests. And the last thing could be that the policy itself is fantastic and working well, but we've got some ownership and beneficiary changes. And again, you could come out being a real hero by identifying these types of problems. Even if no sale is being made, if someone else sold this policy and you've uncovered perhaps a poor ownership or beneficiary, maybe they sent the agent the beneficiary form, it never got processed. very easily you've taken away that client for that other professional, and they're now a client for you going forward. So, worst case scenario, you provide a great service. Best case scenario, you're a true hero by solving some major problems. Now, when we started doing policy reviews a few years ago formally, I had like a 25-page policy review. We were so thorough in what we did. We covered every little detail we could think of with lots of explanations. It was absolutely overwhelming. It took us way too long to prepare, and the clients, they simply didn't care about 95% of what we were giving them. So what I've done today is I've taken that 25-page policy review and I've narrowed it down to 3 pages, frankly, 1 page, because the first page is simply a small cover sheet, and who cares if you even have that? That's obviously optional. The second page is the review itself, which I'll go into more detail in 1 second. And the third page is just a very simple explanation of why we're doing the review, what assumptions that we've made. You've got to provide a little bit of context when you do the review, but you don't need much more than this. Here's a 1-page explanation. I think it provides everything that you need to support the actual review. And I've been able now to take all the input and the feedback that we've received over the last 15 years, and I've come up with something that I think just works very nicely for us. It's a 1-page review. At the top, we have basic information on the insured. And just pause for 1 second. Happy to get you guys copies of all this. I'll give you the contact details at the end. So if you're trying to take notes on what we're including here, rest assured that we'll be able to provide you with all this afterwards. So starting, again, with the insured information. In this particular example, we've got 2 insured. So it's a second to die. Obviously, if it's a single insured, we wouldn't have the person's information below. But importantly, we've got their date of birth, but we also have what rating did they get at issue and what would their current rating be. And we can help if you're a little bit unsure of how to estimate what their rating would be today. That's something that we'll help you with. Again, we have a 1-page form that they can complete. And based upon that information, we can give you what we think they would be able to get in terms of a rating. So that's a very important first step. Next, we have information on their current policy, who the carrier is, the type of product, the policy number. We might be doing reviews on multiple policies, issue date, what they're currently paying, and then we get into some of the interesting information. One is how much death benefit is provided. How many years is that death benefit guaranteed under, and you can do a true guarantee under guaranteed mortality, guaranteed interest. So how many years is it guaranteed? What the cash surrender value is, and then also owner and beneficiary. So now you can make sure that you've got the owner and beneficiary information from the carrier, and now you're making sure that the client is aware of who that owner and beneficiary is. Now, I actually just updated, even though we're very comfortable with this information and what we're including, I updated this review yesterday as I was looking at it in more detail, and I added one more line that's not on here. And that line is annual after-tax income produced. And I think this is a key element that I just added here. Annual after-tax income produced. So great, you've got a $250,000 death benefit, but what does that actually mean in terms of the income that the death benefit produces? Now, if this was an analysis for a supplemental retirement plan or a buy-sell agreement, that might not be relevant. But if the objective and goal of this policy is to provide for income to the family in the event of death of the husband or wife, it's all about the income. The death benefit is frankly meaningless. It's really all about the income. And the general rule that people are comfortable using today is 4%. So we could actually take 4% of that death benefit, and that would be the pre-tax income that policy could generate on an annual basis in order for us to not deplete the principal in our lifetime. So if you take out 4%, that's $10,000 a year. That's how much you can take out and be very comfortable that you're actually not going to be spending any of that principal. It used to be that number was 6 or 7%. Because of the growth of the principal, we could take out 6 or 7% and make sure that we still had that $250,000 in the account that we could continue to draw income from. But now, and this comes from a study that the Wall Street Journal presented a few years ago, that number is 4%. So you may have a client that has $1 million policy and they think they've got a lot of insurance. At the end of the day, what they have is a $40,000 pre-tax income stream. So then we look at it in an after-tax scenario. So is $30,000 a year enough? If not, that $1 million of death benefit actually isn't sufficient. So if we can show them the income that it produces, that might be a way for them to understand that, in fact, they may need more life insurance to meet the goals that they've already stated. So after taking a look at the current policy, we now get into those comparisons. And so the way that I'm doing the comparison is, and I mentioned the two questions that we want to answer, which is if we pay the same premium going forward as to what they're paying in the past, how much life insurance could we get with that premium? Conversely, if we keep the death benefit the same, is it possible for us to actually reduce their annual premium? So those are the two examples that I give. I'm trying not to overcomplicate these, the analysis. So on the left side, I have the option of increasing their death benefit using their current premium. On the right side, reduce the premium, keeping their current death benefit. And I'm showing three different options. These are, three carriers. We work with a lot of carriers here. These are the three that in this particular scenario worked out the best. I'm showing the death benefit. I'm showing the guarantees. That I'm showing how much more death benefit we can get by using one of these alternatives versus their existing policy. And then obviously in the middle, I'm featuring the West Coast Life policy. You could tell this was first done a couple of years ago. West Coast Life is now Progressive. But to increase their death benefit by $75,000 or produce 30% more death benefit for their heirs if they change from their current policy to the West Coast Life policy. Then down below, just a little bit of graphs. So I'm trying to show it in a couple different ways. So if someone is, more visual or more numbers oriented, I'm trying to show them in a couple of different ways to really appeal to a mass audience here. And then on the right side, I'm showing, okay, if we keep that $250,000 death benefit, can we actually lower the premium by going out and looking at some alternatives? So in this example, I'm showing a premium as low as $3,000, which is a 25% annual savings for this particular situation. Like I said, let's take that $1,000 a year. They're used to spending it. If they don't need more death benefit, maybe put that $1,000 a year into an annuity, maybe put into a mutual fund. But let's help them meet some other objectives by saving them some money. And then down at the bottom is where I have the financial analysis, just using the AM Best rating here. I have the analysis of all four of those companies. Obviously, all four are very strong. But perhaps the original policy was sold by a company that has an A- rating or a B+ rating, or even worse. This would be a good way of showing that financial strength. Maybe we can't actually improve the policy, but maybe we can get you a policy that's very comparable, but with a carrier that's a little bit stronger. And maybe that is actually very important to your client. So let's kind of put all this together. And like I said up front, if you ask agents how many are actually doing reviews, I think very few, even though they all know it's incredibly important for them to do. And at the end of the day, I think it's something that they're not sure what is included in the review. They're not sure how to do a review. So let's develop that system. Here's what you need in order for you to do a policy review. First, I would suggest having some type of a letter or email, and I'd have three different versions. One that you can send to a client, one that you can send to a prospect, and one that you can send to a fiduciary, that attorney, the accountant, the trust officer, the individual trustee. So three different letters. You can send it, via mail. You can send it via email. That's obviously up to you. But to me, have that part of your system. You need an authorization from the client to allow you to get access to their policy information if you are not the writing agent. So having that authorization will allow you to go to the carrier, and get those in-force ledgers that we need, the copies of the annual statements, the confirmation of the ownership and beneficiary. Have an underwriting questionnaire, one-page questionnaire. It can be very simple. What's your height and weight? What's your tobacco history? Are you taking any medication? And do you have any family history? Based upon medication alone, we pretty much know what people have today. You look at their medications, you know if they have any health issues. You don't really have to go into a lot more detail initially. Now, if they have, they're taking a lot of medications, maybe we have to actually do some kind of informal, more in-depth analysis. But one page at this point, I think, is sufficient. And then we have our cover letter to the carrier. Be very, very specific as to what you want, because if you're not specific, there's a very small chance the carrier is going to give you what you actually need. Even if you are specific, I would say that there's only maybe a 50-50 chance the carrier actually gives you what you need. I don't know why, but we've always had issues. Maybe the carriers understand why we're doing reviews and that their policy may get replaced. They don't provide us with truly the information we need. But it is very frustrating. Sometimes we have to go to the carrier, a couple of times to get the appropriate information. What I would ask from them is I want a copy of their last statement, whether it's an annual statement or quarterly. I want confirmation of who the owner is and who the beneficiary is. And then I want in-force ledgers. And I at least want two. I want to see how things are going to look going forward based upon the current premium. Usually that includes numbers based upon both the guaranteed rate as well as the current rates. So usually we can accomplish both of those in just one in-force ledger. But if the policy is not going to survive to age 100 or age 120 at current rates and current premiums, I want them to solve and give me an in-force ledger on how much we would actually have to increase the premium to in order to provide that type of longevity of death benefit. Next, we look at alternatives. The best system that I know of is using WinFlex. I can do 10, 15 different comparisons of life insurance illustrations with different carriers in under 5 minutes by using WinFlex. And if you need training on how to use WinFlex or access to WinFlex, we can provide it to you. But it is essentially a standardized illustration system. Not every carrier uses WinFlex, but most carriers do. And by understanding how to use WinFlex, we now can run illustrations for all of the carriers who participate. So instead of having to learn each carrier's illustration system, we learn one system, that being WinFlex, and now we can run official illustrations from many carriers. And most importantly, we can do comparisons very quickly. I can create one illustration for one carrier and copy all that information to another carrier and their product in a matter of seconds. So I can really look at the entire marketplace to make sure that I'm providing my client with the best alternatives. And again, we're trying to solve for looking at the current premium that the client is paying, how much death benefit can we get? And secondly, by keeping the death benefit the same, can we actually reduce that premium? And both of those can be accomplished in WinFlex very, very simply. And lastly, your own policy review presentation. I highly suggest you keep it simple. Your clients do not want to see lots of information. It is overwhelming to them. Attorneys sometimes do. Accountants sometimes do. If you're dealing with a $10 million policy that you're reviewing, and you've got attorneys and accountants, sure, fire off that lengthy review. But if you're dealing with most of the policies that we work with today, clients want simplicity. We have a tendency to overcomplicate things. Let's make it simple again. Have that simple one-page presentation accompanied by a one-page explanation. If you want to throw a cover sheet, great, throw that on there. I don't think there's anything else that you need. Maybe you have a couple of different variations. One, if their objective is just family income protection. Maybe you have like a retirement planning policy review that you do. Maybe you have a key person if that's the marketplace, or buy sell if that's your marketplace. But have that standardized presentation. And then this is your system. It's really not complicated. But I think if we don't have a system, here's the letter we use. Here's the authorization we use. Here's the underwriting questionnaire that we always get completed. Here's the cover letter. You don't have to create a new letter every time to the carrier. Here's the standard letter. You just fill in the information for that particular client. If we could standardize this, we can now get into doing policy reviews in a very profitable basis. We can get them done quickly, and we can get them done the right way. Now, you can do all this yourself. Of course, that's why we're here. We can do all this for you. That's one of the services that we provide at Gateway. If you're interested in that service, Jessica Wilson's the best person to reach out to, or myself, but Jessica is normally in the office and available for your emails or your phone calls. Her email address is jessica@gfalife.com, or you can just give us a call at 415-369-9990. That is the presentation today, the no sale life insurance sale using policy reviews. I hope you got a lot out of it. I think it's a fantastic concept. I think you will provide an amazing service to your clients. And as I said, 60% of reviews lead to some improvement on the client situation, which means 60% of the time you will likely be a hero. You will solve a problem with their owner or beneficiary designation, or you'll provide them with a better alternative today, which means a new sale for you. So you're providing a great service to your clients. You're making a little bit of money for yourself. So this is absolutely a win-win situation for everybody. I encourage you to implement this in your practice right away. Let us know how we can help you, and have a fantastic day. Thank you.